Kia ora, I'm Fiona. Welcome to my Money 101 webinar. The three areas that we're going to talk about today is one about money jargon, and the second one is about money equations, and the third area we're going to focus on today is money mechanics. So you've all done the money jargon quiz, which is, thank you for that, and it was awesome to see that there was, out of the 30 people that participated, we had some great knowledge and understanding in those, in the area of money jargon. So we were testing that just to sort of, for you to clarify and confirm the things that you know, and maybe some of the things that you didn't know. So I'm just going to spend a little bit of time just to go through that and some of the areas that weren't as clearly understood, and maybe some grey lines that were there, because it's so important to understand this jargon in order for us to then progress to the next stages. So the first, in regard to I'm just going to refer to our workbook that we've got here, and if we go down, we come down into the money jargon quiz, and just some, as I said, some key messages that I'm wanting for you to think about when you look at the jargon, the accounting jargon and the financial jargon and the money jargon. One of them is to make sure when you're looking at any money jargon that you're considering whose perspective you're looking at it from. So for example, is it my perspective, or is it their perspective? Is it a business perspective, or is it someone else's, a creditor's perspective, or someone else out there's perspective? So you need to think about whose perspective it is that you're coming from. The quiz itself that you had a chance to look at, and if you haven't had a chance to look at that, go and have a look online at the workbook and do it. If you look at the quiz, we're looking at it from an individual perspective. So say it was from me. So that's important as we move forward and do the quiz, to understand whose perspective you are considering it from. The other thing to consider when you're looking at jargon or money jargon is there's this grey line sometimes between assets and expenses. And we have a good example here, which is the one about uniforms and shoes that you can buy or that you bought. And so number 4 on the workbook, uniforms, shoes you bought. As you know from the definitions, income is money we earn, so it's definitely not an income. It's not money we've earned. Expenses are costs of generating income and running your household. They could be considered, uniforms could be considered a cost of generating your income. There's assets, what you own. So, you know, you could think, okay, well, uniforms and shoes are what we own. So at the moment, we're kind of ticking 2 bits, expenditure and assets. And then we go, okay, is uniforms and shoes you bought what we owe? No, it's not what we owe because we've actually bought them. So there's a grey line between, for uniforms and shoes, it could either be considered an expense or an asset. So the key thing here is, from an accounting point of view, this is an accounting point of view, you also need to consider the fact that, can you sell these? Can you on-sell these and get some money from it? Now, an expense, you can't do that, but an asset, you can do that. So from my perspective, I look at these uniforms and shoes and go, it's something I own, those uniforms and shoes. And so straight away we know it's an asset. And then I ask myself, can I sell it? And the question is yes. So to me, as a result, the uniforms and shoes you bought should be noted as an asset. A lot of people put expense because they weren't 100% sure or classified it as just a cost. But in a lot of, from an accounting point of view, we would classify this as an asset. So just to think about that as you're moving forward when you're considering the money jargon. Another thing to consider is the language. And you'll note that there's, there's different language you start looking for. Rent paid, and you actually hear that word paid, it means you've actually expended it, versus rent received, that means you've received it. So rent paid is an expense and rent received is an income. See the words paid and received. And then we've got this word down here under number 11 is rates outstanding. So outstanding doesn't mean it's paid, so it can't have been expensed. So it must be still something that we owe. And as you know, a liability is something that we owe. So rates outstanding is a liability. So again, it's the words outstanding, paid, received, receivable. So, look for the jargon, look for those additional words, and you'll start to realise where it fits under I, E, A, or L. Another thing to think about when you are looking at jargon is some of this, number 18, IOU note from brother. Now that's an interesting one because most of us would think, well, that's a waste, what does that mean? In whose perspective? It's a little bit confusing, all that written out like that. So this one in itself, you go, well, I get an IOU note from my brother. So what does that mean? That means that he actually owes us some money. So I may have on a piece of paper saying that he owes me $100. But to me, so what does that mean to me? We're looking at it from my perspective. To me, that means I own $100, but to my brother, it means that he owes me $100. So given that we're trying to identify what it is relating to me, the answer for number 18, which is an IOU note from my brother, is that because he owes me, and I have this piece of paper saying that he owes me, even though I might not have it, that to me is something that I own. The $100 that I haven't got yet, but on this piece of paper he's telling me he's got to give to me, I actually own it. So in that regard, because it is an own, I own it, it's an asset. An IOU note from my brother is an asset. As I said, if we're doing it from my brother's perspective, he would record it as a liability. So just again getting clear. So the one last thing I want to just confirm too is this one about KiwiSaver funds and how we say it's paid. And in this regard, we have to think about what it is we're talking about. And as we all know, KiwiSaver money comes out of our wages or salaries, or we can put money aside for KiwiSaver funds. We give it to someone else to manage. In this instance, KiwiSaver funds we might pay it out. It's not an expense to us. It's actually, we're paying out money like we're putting in a savings account, but it's compulsory. So that money that's sitting over there is something we own. So that money, because it's something we own, is an asset. But just a couple of the ones that were a little bit harder for people, or there were mixed views of how that looked, but just to give you an idea of some of the examples. Happy for you to ask for us for more specific feedback on your answers. If you've done the quiz, so let us know, contact Tangata about that, and we can give you some more feedback. But those are the key ones that I think that most of us got a little bit confused, or there were some grey lines. All right, jargon, so important. At the end of this, we're going to send you an evaluation form, but as well as that, we're going to send you another quiz, so you'll get to practice this jargon more. And we're going to kind of push it at another level and do it from the perspective of an organisation. So a lot of you are in organisations, and so you need to learn some of the jargon around that. Again, just keep it simple, I, E, A, and L. and then you'll be fine. Hoping that that clustering of those words will actually make it easier for you to understand some of this many jargon that's out there and some of this hard jargon that's out there. So let's work on that, and then I think the jargon will make it permanent, a little bit more permanent. Let's go now to the next part of our webinar, which is talking about money equations. So we need to understand the jargon, which is what we've done and you do, and you're starting to do, confirm more. Let's move on to the next part of the webinar, which is about now putting that jargon into two equations. One is, there's two equations. I call them one line and the bottom line, top line and the bottom line. And as you can see in the workbook, there's the equations. Income minus expenditure equals surplus. Assets minus liabilities equals net worth. So the reason for showing the two different lines, it's not just about one line, it's about two. Firstly, you can see that they're different pieces of information. One's about income and expenditure and what's left over, and the other's about assets and liabilities and what makes up our worth, what we are worth at this particular time. Two different pieces of information, two pieces of information that are useful for us to know in order to make some more informed decisions with money. Also, I just want to say that a lot of us tend to focus on the top line and only the top line, because we're thinking that that's all we need to focus on, getting income and paying out expenditure, income, expenditure. Whatever's left over, we spend some more. By introducing and showing you that it's not just about that top line, it's also about that bottom line, we can start thinking a bit more strategically about how we use the surplus and focus also on building our net worth. Let's do an example around that, which will hopefully help you see that it is, you know, the two pieces of information are very important for us to understand to make some better financial decisions and money decisions. I've got this workbook on the following pages that we're going to work through by using just the four areas: income, expenditure, assets and liabilities. I'm going to give you a scenario, a practical scenario. We're going to work through it together and we're going to put it into the different bits, and then once we've put them into the different places, the I, E, A or L, we're going to then be able to see what our surplus is and see what our net worth is. And then from that, we should be able to get a picture which is going to help us make some more decisions moving forward. So here's the scenario we're going to use, and we're going to utilise Hariata in this example, and we're our 26-year-old that's done some amazing things in her life and travelled all over the place, loves travelling, enjoys life and makes the most of it. But she's been smart in that process, and she's been on one of these webinars. She's realised, she's going to set some more goals for herself, but in order to do that, first she needs to actually just get a view of what her income and expenditure is, and also get a view of what her assets and liabilities are, so that she can then work out what next. So in this example, in this scenario, Hariata, she lives in Auckland, but she also, she has an affinity to go to Waihi and a few other places, and so there's some stuff that has happened over her 26 years of life, and some of that we're just going to talk about now. She's realised that she's got some various things. So here we go. So she's looked at all her records and she's got some shares. She actually managed to get some really good shares, some IT shares that she purchased a while ago, and so she has some shares worth $5,000. And as you know, shares are an asset for her. So if we put shares in here under assets and $5,000, okay, she's recording an asset of $5,000. Also, she recognises that with those shares, she's managed to receive some dividends, some earnings of those shares. And last year, she was quite lucky. She received $1,000 worth of dividends. So we put dividends, because that's an income, as you know, $1,000. So at the moment, we're recording Hariata as having $5,000 worth of assets and $1,000 worth of income. She also has a car, and it's worth $20,000. So let's put the car in. That's the value of the car at this particular time, $20,000. In order to get the car, she was lucky enough that her mum gave her a loan of $5,000. So, and we know that mum giving you a loan we need to record that as something that we owe to our mum as a liability. So our loan to mum, thanks mum, of $5,000. So we've got that recorded as well. So we've got the loan of $5,000, and the other bit that enabled her to get the car of $20,000 was a hire purchase. So she has a hire purchase for car that she needs to have noted down. If she doesn't note it down somewhere, she might not keep a track of it. She knows money's going out, but she needs to have noted down what the liability for the true liability for the car is. So it's made up of the loan to mum, but it's also made up of the hire purchase. If we just recorded the car, then that wouldn't be correct. We need to record the two aspects, the three aspects of the purchase of the car. So now Hariata's got more assets, she's got some liabilities, and she's got a little bit of income. With the car also, we're talking about the car, we can bring in, she's also got some petrol expenses that goes with the car, as you know, and repairs that go with the car. So we need to record some petrol costs and some, repair costs that may need to be, or that have been incurred to date. So this is over a period of time. So she's paid out petrol, which we know is an expense of running her car, and repairs. All right, so and those costs, she's paid $3,000 worth of petrol and repair costs, over this year, mostly petrol. But she has a bill, an outstanding repair bill, which is to the garage, which I've been really understanding that she's allowed to pay it off over time. So we just need to record that liability because it's something she owes. There's a repair cost, repairs outstanding of $2,000. Just the reality with vehicles, as you know, but she's wanting to put it all down on paper so she can see what her true costs are related to. Also, Hariata, she's been very smart, and she realises that she can't afford to buy, at this stage of her life, a house in Auckland, and so, but she still wants to get on the property market, and she has. She's decided she's actually bought a house in Waihi. She bought a batch, which is $200,000. The cost of that house is $200,000. Pretty much a steal. One day it's going to be worth a lot more. So we need to put on her assets, because it's something she owns, a house. On the other side, and she's used the Kiwi Saver, which she's part of, to actually access some of the deposit and stuff like that. So she's allowed to use that. But that's something over there. But with the house, she's managed to get a mortgage, and her mortgage is a liability, and it's $150,000. But again, we need to record the asset of the house and then the liability of $150,000. The money for the deposit that was taken somewhere else, that doesn't even enter on here. So straight away, she has this house which is $200,000 and a mortgage which is $150,000, which is awesome that she has, and she just wants to record that. Also with the house though, she has had to pay rates, and as we know, rates that she has to pay is an expense, so we put it over there as rates. She's paid $1,000 and more of rates. And then she also knows she's still got another $1,000 for this year to pay for rates. So she's got a rates outstanding, and we know rates outstanding are a liability. So we put that over there as well, and for liabilities is $1,000. And because she's not living in Waihi, she's renting it out. So she's able to bring in some rent from that house, which is being smart, of $10,000. So as we know, rent that she can bring in, rent received, is income, and it's $10,000 worth of income. It's going to help her meet all her payments and her costs. So rent received is $10,000. Given that she's not living in Waihi and she's renting it out, she also knows that she has to be paying rent for where she lives in Auckland. And Auckland's a little bit more expensive, as you all know. So she needs to recognise in her piece of paper here her cost of renting in Auckland. And so the cost she's worked out renting in Auckland is $25,000. And as we know, the cost of her being a cost is an expenditure here on this piece of paper. So we put in rent paid, expenditure of $25,000. A lot more expensive, obviously, in Auckland than it is in Waihi. So we're just recording all these bits of Hariata. Just a couple more bits that she's recognising too. 3 or 4 bits. We've got her salary. She's in Auckland, she's working, and she's on a salary. So she's got $60,000. She's on a $60,000 salary. She's worth way more than that. At the moment, her salary is $60,000. So let's put salary in under income. We know she's receiving it of $60,000. And also with her salary from each year, she also acknowledges even after she's utilised it for purchasing a home, she's been putting quite a bit in, and she's got KiwiSaver funds that are sitting in someone else's KiwiSaver management fund, and they're being managed for her. But as we know, KiwiSaver funds that she's put money into, and then her employers put money into for her, is all hers. She owns it. So we put it as an asset. She knows her balance. The KiwiSaver is $12,000. So put that as an asset over there of $12,000 for a KiwiSaver. She's slowly also been putting aside, she's pretty amazing, Hariata, and thinking about the future and thinking about setting herself up well. She's put some money into a savings account. She's just doing APs, little amounts of APs from her salary, and she's got a savings account of $2,000. She's trying to build that up again so she can go on her next trip. The savings, we know, is an asset of hers. She's got money in the bank of $2,000. She's earned a little bit of interest. She earns a little bit of interest from that savings account, and the interest she earned this year was $200. Not a lot of money off savings account and putting money in this bank at the moment, as we all know, but she's earned some interest of $200, and she just wants to record it as all the sources of income that she gets at the moment. And then she's done her final think about the things that are going on for her, and she's got lots of household costs, and she's got, you know, some fun costs and her travel costs and the things that she likes to do and go out with her friends and stuff like that. She's worked out that probably she spends in a whole year about $30,000. So You know, she needs to be realistic about that. So she's putting that as an expense, household and or put it household or other costs. You put other costs there, living costs. You know, we'll put $30,000. By the time she's added it up, you know, she wants to live life while she can. She's got about $30,000 for the household and living costs. And the other thing that she just realised she forgot about including in there was the internet fees. She's got some internet costs that she needs to keep on top of, and they're worth $2,000. So let's put that there as well. She's got internet costs of $2,000. Enables her to keep up with everything and keep on top of all of this sort of stuff. So there's the scenario for Hariata with her taking a stock take or review of where she is in terms of her income, her expenditure, her assets and her liabilities at this stage. Oops, sorry. So now we're going to, as the equation says, income minus expenditure equals surplus. We're going to work out her surplus. And assets minus liabilities equals net worth. We've put down, we've not added anything at the moment. We've just chucked it into the I, E, A or L box. Now we're going to add it up, which is what I'm going to just do quickly for you. So if we add it up, you can check it yourself later. We're going to add up that the total income she receives is $71,200. And then her total expenditure for a year is $61,000. So that means that she has surplus to do whatever she wants to with of $10,200. It's pretty cool. So she actually has a surplus. It's not the only way around. But also in assets, she's blown away by the fact that she's actually got $239,000 worth of assets. And when we add all up her liabilities, she's got $173,000 worth of liabilities that she needs to understand as well. So it's not just assets, she has liabilities that relate to those assets and to her living. And then we'll work out assets minus liabilities. That comes the difference, her net worth or her worth at this particular time. When you hear this, when you hear millionaires and you know these people saying, you know, the top of the rich list, what their worth is. This is how you work out their worth. You work out their assets minus liabilities, and that's their net worth. But they would have also worked out their income and expenditure. So Hariata is looking at, she's worth, which she probably was blown away to find out, she's actually worth, right now, at the age of 26, she's $66,000 worth of net worth value. But it's not just that, she's got surplus that she's earning, you know, she can use extra, she's living, and she's got all these assets that are able to generate her some, you know, some income as well. And the idea is to now, if we can move on to the next bit, is now to understand for Hariata how best she can make some decisions moving forward. So if we just go down to the next bit, the final bit of our webinar session, I just want to tie this together and then we'll come back quickly to Hariata's situation. If we understand the jargon, we can actually then put it into these two equations that are here. Income minus expenditure equals surplus. And it just shows you an example of how you do that. Assets minus liabilities equals net worth. And we've just seen how we do that. Some different information that we can glean, which will help us understand what we need to do next. And so once we work out our income minus expenditure equals the surplus that we're left with, then we can actually start thinking, okay, I've got a surplus. Not like Hariata, she's got a surplus of $10,200. So she's got a surplus. So the question is, what does she do with that surplus? the normal thing is that we spend more. We think that if we've got a surplus, we can spend more and spend it more and do more fun things like that. That's definitely one thing that we can do. But also, what she could also do, knowing she's got this line up here, the assets minus liabilities line, what she can also do is now understand that actually the surplus, she can use some of that surplus and create more assets for her. Also, she can use some of that surplus and reduce her liabilities. So she can use that to reduce her liabilities, she can use her surplus to increase her assets. And if she does that, then obviously her net worth is going to go up. By increasing her assets or decreasing her liability, her net worth is going to go up. Versus if she just used her surplus to use it for expenditure, nothing would happen to this line. So now Hariata has more options to be able to utilise that surplus that she had. And she can think more strategically about what she wants to do with that surplus. Also, given that Hariata knows that she's got these types of assets, she's got shares, she's got a car, she's got a house, she's got KiwiSaver fund, she's got savings, she knows she's got those sort of assets. So she's looking at those now going, okay, assets. I want my assets to create more income for me. And as she knew with the house, she's got a house and that's enabling her to get more income. So she can do that. Or she can buy some, from her surplus, she can buy some more assets that enable her to create more income. Because if more income is created, then she's going to have more surplus. So then the mechanics of this goes round and round and round. You know, she can, as long as she creates more assets, she can create that generate income, she's going to get more surplus, and then it can grow and grow and grow. So she can also look at her assets and go, is this creating income for me? And if it is, she might want to put more money into those sort of assets, or get some new assets. Or she might look at her assets and go, this is not creating money for me. This is more of a, you know, this isn't that greater generation of income. Maybe I need to think differently about what assets I hold. The other thing is that she can start thinking about her liabilities too. Now that she's got them written down, she'll see them and she'll be able to go, well, okay, what can I get rid of with my surplus? What can I get rid of sooner than later? So she might decide that she might have surplus and she's going to look at her liabilities. She goes, well, let's reduce my liabilities, therefore I can reduce my expenditure. So instead of paying more money, if I have more money in liabilities, that means you have to pay interest or penalties or whatever. But if she can use her surplus to reduce her liabilities, then there'll be less expenditure that she needs to incur. And again, if you reduce your expenditure, you can increase your surplus, and then you'll have more money to utilise in this whole the two equations. So she can get smarter and make some really strategic decisions about what she does with her surplus. So hopefully you can see that by understanding that there are two equations, that you can actually be a bit more strategic about, and once you've actually noted down your own assets, liabilities, income and expenditure, you can actually start to make, you have the ability to make more informed judgments and more effective decisions around your own money management. This is such a useful tool globally, it's everywhere. This is not going to change. So the sooner you start thinking about this for you, I think it's going to make it easier and more clearer for you to make some amazing decisions and set yourself up. We've got some tips on the following page that you can utilise, but we hope that this webinar has been useful whether it's to clarify your thinking or even to add some more value to your thinking around money management. Looking forward to your feedback, and as I said, we'll be sending out you another one of those quizzes on the jargon to help you with your understanding. And let us know if there's anything else we can do. Thanks to Toi Tangata for letting me be involved, and honestly, I hope this is going to be useful not only for you, but your family and your role in managing any financial information moving forward. Kia ora koutou.